Hi everybody, this is Dave Aquino from Value Charts, and this is the free video for September 1st, 2016. Alright, so the first thing to keep in mind is tomorrow on September 2nd, we are getting the non-farm payrolls report rolling out here at about 8:30 a.m. Eastern Time before the opening bell. Now, there is some opportunity here, because the thing about non-farm payrolls and why it actually has an extra emphasis this month is because last week during her Jackson Hole, Wyoming speech, Janet Yellen emphasized the fact that we're getting pretty close to hitting the employment targets set forth by the FOMC as a gauge to improvement in the U.S. economy. A couple of Fed governors also said that before her speech. So a lot of eyes this entire week has been leading up to the non-farm payrolls number. Now, normally in our trading room, we're paying attention to things like the ADP employment report, which is showing that this is an increasing number of hitting the consensus number, actually moving above it. So there are increasing amounts of jobs being put out there. And again, that's the ADP or private payroll number in the markets. So we're also looking at things like jobless claims. So jobless claims actually reflects how many people are filing for unemployment. That number is actually lower than the consensus number. So that is also a bullish sign on the market. The next thing is the Challenger job cut report. So this is a report showing that the announced layoffs numbers is falling from the prior number. This month it's 32,000. So in terms of the economic reports that are leading up to the jobs number is the fact that they're positive, they're bullish. Now, if you remember, the past two non-farm payroll numbers have blown away the expectations. In both cases, a positive result would have been a number above 200,000. The consensus number has been around 155, 175, those levels, and we keep overshooting those jobs created by close to 100,000. If the trend continues, any number above 200,000 is kind of what's expected, and that's a bullish move above the estimates. So if that does come to fruition, then the Fed actually was probably more likely to raise interest rates in here in September. Now, that's not a surprise, and I think the market will react to it in a positive way. That yes, the U.S. economy is improving, the job situation is improving. It gives us clarity in terms of what the Fed is going to do, even if they raise interest rates by 0.25%. So I actually think that the market will react positively. Now, you can see that the market in the past week and a half has been slowly rolling over. You have the 8 EMA moving lower here. And I actually think what's going to happen is you're going to get a bullish bounce into the 8 EMA and possibly even move a little bit above it. And I think that will carry over through the beginning of next week after Labor Day. Now, if market does react poorly to the number, that you will find support on the 50-day EMA, and then potentially a little bit of support here based on this neckline, this pivot low right here around 2148. Now, the way we've taken advantage of it is we've actually sold a bullish put credit spread with its short strike here at 2125. Not only is it below the 50-day, it's also below these MQ trend dots at 2130. And again, we also have this pivot low right here at 2146. And the fact is, right now, the current price is 2165. This is 2125. This is 40 points away. This is about 10 to 15 points further away than we normally are situated. So the profits for tomorrow again, this is a bullish put credit spread that expires tomorrow, is in very good shape because according to the economic reports and what we expect from non-farm payrolls, we look for the market to move higher. If it doesn't, then there is plenty of support for the success of this bullish put credit spread. So, best of luck trading.